We're talking about the Fed, the central bank policy, and how, we'll just take it higher for longer. We'll just keep it higher. What the Fed's doing to fight inflation, and how it's completely wrong, and how they're really stuck. They're really between the proverbial rock and a hard place. Unfortunately, there's maybe only one way out of this, and it's not good. As a matter of fact, it's not good at all. So they've been raising rates to try to bring inflation down. But the problem is, as I've been explaining, if you've missed it, go back and listen on the podcast. Just search the Mark Moss Show on your favorite podcast player. Catch me on YouTube at Market Disruptors. But as they've been raising rates, they haven't really slowed inflation down because it's not the consumers spending that's the problem. It's the government spending that's the problem. And the government's going to spend no matter what they do with the rates. But what it does do is it makes the government spend even more for two reasons. One, as they raise the rates, consumers, you and I, we're more broke, which is what they're trying to do. And so the government doesn't have as much, they don't have as much income. We don't pay as much taxes. So the government's income goes down, which means they need to spend more deficit spending, more debt. And because interest rates went up, the cost of that debt, the payments on the debt go up. As a matter of fact, the United States government debt, the interest on the debt has now eclipsed the amount of money that the U.S. spends on its military. Now, the U.S. spends more money on its military than the next 10 countries combined. More than China, more than Russia, more than France, England, Britain, whatever, all of them combined. And the interest, not paying down the debt, just the interest on the debt has now eclipsed that. So it's really causing a problem. Now, as I said, in the 1940s playbook, if they were to keep interest rates low, even though inflation was high, then it could reduce the government's inside of the inflation a little bit, but it encourages a speculative attack on the currency where we go borrow as much in that currency as we can to go buy any assets that we can, like how I went and bought a couple properties when I could get 30-year fixed at 3% when inflation was over that. All right, I explained how that works before. I'm not going to go through that again. So what do? It's a pretty dangerous situation. If we don't raise rates and inflation runs hot, we get the speculative attack. If we do continue to raise rates, then we just make inflation worse. So what do we do? Well, this is where things get a little scary. So if let's just run this back one more time. So let's see. If we continue to raise rates, we make retail broke, but that doesn't really solve the problem, and it actually makes the government deficits worse because of the deficit spending. But if we do lower rates, it will reduce the government deficit spending, which is the main problem. But then we open ourselves up to speculative attacks. So there's a third potential choice. And this is where it starts getting scary. And this is what basically every single empire and country in the world eventually leads to. This is the final stage. When this happens, it's kind of over. A lot of the world has this, and a lot of the United States has it, but we don't have it on a big scale, and that is something called capital controls. Capital controls are basically controlling the capital, controlling the money, controlling the flow of money in and out of the country, and also the price of goods. So, for example, in California, in Los Angeles, for example, they have rent control, right? That's a price control. It's a capital control. So, well, rents are going up too much, so we'll just say that homeowners can't raise the price of those rents anymore, right? But capital controls are much worse because it controls the flow of capital in and out. I literally just today, at the time of this recording, got home from being over in Spain where I was at a conference. I was speaking at a conference over there. And most of the people there were international, which I guess is why I was in Spain. Probably at least 2/3 of the group were international. And they were all business people, entrepreneurs, et cetera. And many of them I talked to from sort of like the Nordic countries, so Denmark, Finland, Sweden, et cetera. And I was really surprised, like in the Netherlands, for example, I didn't understand the extent of the capital controls that they have. And so these are business owners, and they're doing business selling, whatever they're selling, supplements or fitness equipment or whatever, all across Europe. But the government doesn't want money to go in and out of the country. And so it makes it very difficult for them to do business. Some of the team that ran the event are from Argentina. Argentina has some of the highest inflation in the world, and they also have capital controls. So, for example, you have the Argentine, I think it's the Argentine peso, that's losing 100% of its value, and so you don't want to hold that, right? So you want to exchange it for something else. Well, what would you exchange it for? Well, people would like to exchange it for $1. So the official exchange rate, I don't have it pulled up in front of me, so don't quote me exactly, but the government tells you that the official exchange rate, because they're trying to make it look like it's not so bad, is like 250 to 1, 250 Argentine pesos to $1. But they only allow you to exchange, and they just told me this last weekend, so I don't have it written down. So again, sorry for my not being completely factual, but something like the government only allows you to exchange, $100 of that or something like that. So then there's a black market for that, and the black market is like 500 to 1, approximately. Because people don't want to hold the Argentine peso. They want a dollar. So even though the official rate says that, since they can't really do much of it, they'll just pay the black rate, 500, 550 to 1. But here's the thing. The government won't let you spend more than, I should have written these numbers down. I think it was like $300 on their credit card. So these people, they're in Spain. They're traveling from Argentina, but they can't spend money on the credit card. Well, they can, but only up to like a couple $100. Once they go over that, then it's way worse than even the black market rate. Then it's like exchanged at like a 700 to 1 ratio. Why do they do that? Because they know that the people are going to be dumping the Argentine peso as fast as they possibly can, causing a speculative attack. That's exactly what they don't want. And so that's the only way to stop it. Nobody's going to want to hold a currency when inflation is running that high. And that's exactly where the United States finds itself in. So, damned if you do, damned if you don't. Inflation's raging high. The more we raise rates, the worse it actually gets. But if we lower rates, we have a speculative attack. So what do? Well, we do what every other country in the world has done, is doing right now, and that is imposing capital controls. And like I said, that is very, very, very scary, especially, being in the United States, the land of the free. We don't want our money being locked down. But of course, this is what they have to do. It's the only way they can do it. It's the only way they can do it if they want to try to protect their currency. Some countries, Argentina, Nigeria, they've completely cut off access points to cryptocurrency because, again, people will trade their currency that's losing value for anything. It's what Ludwig von Mises calls the crack-up boom. And he says, and then suddenly the people realize that inflation is both permanent and intentional. And then they lose all confidence and they want to exchange that currency for anything they can as fast as they can, and the currency ultimately plummets. Unless the government doesn't allow you to do it. It's the only way to stop it. And this is not a conspiracy. So this is what's been done in the 1940s. The IMF, International Monetary Fund, put out a paper in 2015 titled, quote, "The Liquidation of Government Debt." And it outlines something that we call financial repression. And it says that in this paper, quoting it, it says here, quote, "We suggest that once again, financial repression may be part of the toolkit deployed to cope with the most recent surge in public debt in advanced economies." So what they're saying, it says here, quote, "Financial repression is most successful in liquidating debt when accompanied by inflation. For the advanced economies, real interest rates were negative half the time." So what they're saying in this paper is the goal to get rid of the debt is to lock you into the bond market that pays a very low yield when you have high inflation. So they inflate their debt away, trapping you in the system so there's no escape out for you, and stealing your wealth to bring theirs back down. It's a very, very scary thing. Now, we've seen this in some shape or form already, but it's only getting worse. And unfortunately, it appears that it's the government's only way out. Damned if you do, damned if you don't. And you and I are caught in the middle. Now, what do? Well, you get out while you still can. Buy gold, buy Bitcoin, buy some houses, buy something, because otherwise you're going to be stuck in this financial repression nightmare.